My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends. I'm just trying to save you some money. My job is not just to educate, but to entertain and teach you. Call me, 1-800-743-CNBC, or tweet me at Jim Cramer. We just went through the worst week since 2008, with the Dow plunging another 913 points today, S&P plummeting 4.34%, the NASDAQ nosediving 3.79%. At one point, the market looked like it was going to roar, and you know what? We were actually lucky. We were lucky it was only down that much, because if things don't break right, we're going to be experiencing a lot of weeks that are worse than the depths of the Great Recession. Why? Because we are fighting a two-front war in this country right now. We need to beat the coronavirus, a scourge that's unrelentlessly easy to catch and often requires hospitalization, far more hospitalization than we can actually provide. At the same time, we need to preserve the economy, an economy that in many ways is no longer open for business. There are 100 million workers who could potentially lose their jobs if we don't shut down COVID-19 soon. People's life savings are going to be pulverized as company after company suspends their dividends. Investors sell their 401ks into this maelstrom of fear and unremitting panic because they need the cash. They need the cash right now. It's like a slow grind financial health apocalypse. The plummeting of price of oil, it isn't helping either. We need to get crude back over $30, or else the layoffs in the oil patch will be immense. Fortunately, that's a man-made crisis that the president can stop with one phone call to the Crown Prince of Saudi Arabia. It was the decline in oil that turned the stock market from up till down. Unfortunately, right now, we seem to be losing the war on both fronts, the virus and the economy. While I'm confident that we'll ultimately triumph over COVID-19, as confident as everyone else, it might not happen fast enough with tens of millions of laid-off workers burning through their savings. God help anyone who was living paycheck to paycheck. Next week, the healthcare front and the financial front, well, they're going to collide. When we come in on Monday morning, we're going to learn the true size of the Senate stimulus bill. It needs to be as big as possible. I'm hearing $2 trillion, larger than many people expect, but I think $4 trillion makes more sense. People keep saying we need to fight this thing with a bazooka. I mean, are you kidding me? We need thermonuclear weapons. You know why? Because we're also going to start hearing about an explosion in new infections, hospitalizations, and deaths. We know this virus spreads exponentially, but we have trouble processing what that means. So the figures will seem stunning and terrifying in equal measures. The government's behind the curve when it comes to the fight against the pandemic front. The least we could do is take these financial fears off the sagging shoulders of America. Believe me, it's worth the effort and the money. As long as we can tide over regular people while we wait for some kind of treatment or vaccine, the stock market will eventually stop cratering. It will help people's savings. Our only hope on Monday, if the president does call the Saudis and resume the riot act over the weekend, that could prop up the price of crude. Saudi Arabia and Russia are engaged in the dumbest price war in history. They're overproducing to crush both the American industry and each other. The Saudis want us hooked on their cheap oil again, but that's a pipe dream. They can destroy our oil companies, by the way, but they can't actually destroy our oil. Still, I can't believe that Exxon now yields 10%. Seems as unsustainable as it is sacrosanct. Now, it's been tough to focus on stocks during the week, but that's what we do here. And the second most touted stock this week after Amazon is what might be a winner is Nike. Now, this thing has plummeted from 105 down to the 60s. Analysts are keen on Nike posting a better than expected quarter on Tuesday after the close. That would surprise me, given the collapse of shopping worldwide. But China's now back online, and maybe people are ordering shoes and apparel online. Here's what you need to know. Nike's the first big cap company reported in the era of COVID destruction, or at least the first one that the analysts actually like. So let's see what happens. The bullishness here is a little bit out of whack. Wednesday morning, we hear from a very fine company you're familiar with if you watch the show, Paychex. It's a stock that's been bent, spindled, and mutilated. It was down 10% today alone. It has fallen from 90 to under 52, almost in a straight line. Why? Because it's a payroll processor for small businesses like the ones I have. And we have to expect more small business closures than at any other time since the Great Depression. Lack of clients. I think it's going to take some time for this to unfold, but the market isn't waiting around to find out. You know what was loved going into the pandemic? Micron. Now, this commodity chip maker is totally despised. Too bipolar? We'll find out after the close when Micron tells us how bad the supply-demand imbalance is. Things had gotten tight when the stock soared to 60 a little more than a month ago. Now it's fallen to 36 bucks. Micron could bounce if we get positive economic data, but that seems incredibly unlikely. Thursday morning, we hear from Signet Jewelers. I don't know if you remember, we had them on not that long ago. It's kind of a tragic story now. This company was experiencing a long-awaited and deserved comeback before the coronavirus devastated all things retail. If they can tell us online sales may be held up or people are still getting married or really, I don't know, anything positive, it might help. The stock's at $7 and change. It currently has a yield of 19%. Welcome to the pawn shop era. After the close, Lululemon reports, and this one's almost as beloved as Nike. There are so many analysts who think it's time to step up to the plate and buy Lulu after the stock's quick 100-point decline. 100%, that'd be something. They argue that Lulu is a coiled spring. My view, if you want to bet on Lulu, please wait until Thursday to buy it. I'll expect you to get a better entry point because on Thursday morning, we get jobless claims, and they'll be more frightening than anything Stephen King's ever written. Remember, I say that as someone who thinks King is our generation's Charles Dickens, so I'm putting him in the pantheon. Right now I'm reading The Institute. Can't put it down. But I'm begging you, don't read The Stand right now unless you want a dark comparison to the current pandemic. Spoiler alert, we're actually doing better. Finally, on Friday, I used to pay attention to the Baker Hughes rig count. It was to measure the amazing health of the oil industry. Remember how growing it was from 8 million barrels to almost double? Now I watch it to measure the scale of the carnage. Maybe if the contraction's deep enough, the Saudis will declare victory and let prices rebound with the help of a president who is torn about America's love for low gasoline prices versus energy independence. Either way, it's now an inverse gauge. The fewer the rigs, the better. I used to have a kind of gallows humor about days like today. I joked to the desk of my old hedge fund, buck up, you bunch of jokers. At least stocks stop at zero. Yeah, it is funny the first time. That's about it. The bottom line. We know this market is the most oversold it's ever been. We know that if there's any good news, a clinical trial success, more testing, a cresting of new cases in Italy or Spain, a $3 trillion stimulus bill, or oil back up, say, at 26, the average is a roar. But somehow, all these positives, they seem to have become long shots. What can I say? I calls it like I sees it. Bart in Ohio. Bart.
How you doing, Jim?
That's a long day.
October, okay, good. Hey, last October, you compared Six Flags and Cedar Fairs, and you chose Cedar Fairs.
Right.
Today, president of Cedar Fairs announced that they won't open till mid-May or later. With all that is going on, are they good investments or stay away from both?
We're in a different time. I think that these are companies that are uniquely what you can't really touch in what is a once-in-a-million thing. I mean, you know, it's one thing to be run poorly like Six Flags was. It's another thing to be run really well like Cedar Fair and still get, pulverized. I'm not going to recommend it. I don't know when this thing's going to pass. That's what it is. Don in Florida. Don.
Hey, Cramer, this is Don in Orlando.
All right, Don.
I'm 78 years old, and I've got 6,500 shares of AT&T, and I depend upon that to live on. What do you think's going to happen with the dividend, and what do you think of the stock?
I actually like the stock. We did an ActionAlertsPlus.com club call the other day, and I talked with our team about maybe it was time to look at ATT because now, well, it was at 30. Now it's at 28. But I happen to think that it's real. I think they have good cash flow. I don't see the cash flow hurting. So I'm going to say you're okay. Let's go to Ross in Texas. Ross.
Hey, Jim. Thanks for taking my call.
Of course, Ross.
Hey, my question is relating to Ventus. I bought that stock back in December looking for some stable income.
Right.
And since I'm considering retiring soon, obviously Ventus has been decimated like most REITs in the market in general. I know you've been a long-time admirer of Deb Cafaro, and I understand that they intend to maintain their dividend. What is your opinion of the senior housing industry in general?
I think the industry's not a good one. There was overbuilding. I was heartened when I saw that Deb Cafaro declared that dividend. I think some people thought it was not sustainable. I believe in Deb Cafaro, but there's an industry that she thought was turning, and it hasn't. And that's a tough judgment, but that's the case. Let's go to Brad in Massachusetts. Brad.
Hey, Jim. Booyah!
Booyah.
I wanted to say thank you. I want to say thank you for all your help over the years. As although I'm only 28, you saved my marriage a few times. But things are getting rocky again, and I'm curious about Home Depot overall, given my time horizon.
Well, I I did have fear that Home Depot would keep going down, and it continues to go down. It yields 4%. That's a little extreme. This thing is trading very much like it traded in 2007-8. It's a better company, and I think it's going to come out on top. It's down 30%. Get it yield 4.5, 5. I think you're going to love it. Right. We are fighting a two-front war in this country, people. What can I say? I got to tell you, I still think you hang in. We didn't like it. 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 We still don't like it. But I don't think it's time to cut and run. We could get a better time to sell. On Mad Money tonight. After yet another tumultuous week, I'm on the hunt for buying opportunities. Don't miss my exclusive with the CEO of CrowdStrike to see if the move higher can continue. The stock had a huge week. Then while Dr. Fauci worries about your health, I'm worried about your portfolio. I'll tell you what can be done to help when it comes to the coronavirus. And as we brace for the worst when it comes to the outbreak, I'm talking to the CEO of AMN Healthcare about how it's hoping to help. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.